Hey everyone, welcome back to MarketSnap. Chipotle stock has been on a wild ride lately. It ripped higher after a solid earnings beat, and then got slammed when news broke about a salmonella outbreak linked to jalapenos served at some locations. In just a week, shares dropped over 13%. Now retail investors are asking the big question, is this a buying opportunity, or is the risk just getting started? And to make things even more interesting, the CFO just sold over $300,000 worth of stock. So today, we're putting Chipotle under the microscope. We're going to dig into the financials, break down the recent drama, run it through the MarketSnap valuation engine, and figure out if the numbers support a comeback or if this burrito giant is facing a serious case of indigestion. Let's get into it. Before we dive into the valuation, let's set the stage. Chipotle Mexican Grill is one of the most recognizable names in fast casual dining. It's a company that basically created the food with integrity movement, focusing on fresh ingredients and customizable burritos, bowls, and tacos. But lately, it's been dealing with a lot more than just guacamole prep. Between a challenging consumer environment, rising costs, and now a fresh food safety scare, the narrative has shifted from growth machine to can they handle the heat? For those who don't know, Chipotle was founded back in 1993 by Steve Ells in Denver, Colorado. What started as a single burrito shop has grown into a behemoth with over 3,500 locations across the US, Canada, the UK, France, and Germany. They operate primarily through company-owned restaurants, which gives them tight control over quality and the guest experience. The current CEO is Scott Boatwright, and the company employs over 130,000 people. It's a massive operation, but it's also one that carries a premium valuation because of its historical growth rates and high returns on invested capital. Let's talk about the top line. In fiscal year 2025, Chipotle generated just under $12 billion in revenue. That's a solid increase from the $11.3 billion they did in 2024, which itself was a jump from the $9.8 billion in 2023. The growth engine here is pretty straightforward. New restaurant openings and same-store sales growth. Almost all of that revenue, we're talking over $11.8 billion, comes from food and beverage sales. Delivery service revenue is a tiny sliver, just around $60 million. Geographically, the U.S. dominates, accounting for nearly all of the revenue at over $11.6 billion. So this is very much a domestic story, with international expansion still in its early innings. Now the earnings picture is where things get interesting. In the most recent quarter, Q2 of 2026, Chipotle delivered a beat. Comparable sales rebounded to 2.2% growth, helped by new menu items and a revamped rewards program. That was a relief for investors after a rough patch. But here's the catch. The company itself said those annual targets do not include the financial impact from the Minnesota salmonella outbreak. That's a huge red flag. They had to pull jalapenos from some restaurants, and we all remember what happened the last time Chipotle had a food safety issue back in 2015. It took years to recover. Looking at the broader trend, net income has been climbing steadily. They did about $1.5 billion in net income in both 2024 and 2025, up from around $1.2 billion in 2023. Diluted EPS has gone from about 89 cents in 2023 to over $1.14 in 2025. The margins are holding up with a gross margin around 24% and a net margin around 11.4%. But the market is forward-looking, and the big question is whether the recent momentum can continue with this new overhang. Let's pull up the balance sheet and cash flow statements, because this is where you see the real financial health. Chipotle is a cash-generating machine. In 2025, operating cash flow came in at over $2.1 billion. After capital expenditures of about $666 million, free cash flow was roughly $1.4 billion. That's a strong number. They're also returning capital to shareholders aggressively. In 2025, they spent over $2.4 billion on financing activities, which is mostly buybacks. They don't pay a dividend, so all that cash goes back into repurchasing shares. That's why the share count has been declining at about 2% a year. On the balance sheet, they have about $350 million in cash, but they also carry a decent amount of debt. Total liabilities are over $6 billion. The debt-to-equity ratio is sitting at around 2.46, which is a bit high for a restaurant chain, but it's manageable given the consistent cash flow. The return on equity is impressive at over 53%, and return on invested capital is around 18%. These are top-tier metrics that show the business is very efficient at generating profits from its capital base. Okay, let's break down the classic SWOT analysis. Starting with strengths, Chipotle has an incredibly powerful brand and a loyal customer base. Their focus on high-quality, sustainable ingredients gives them a pricing power that most fast food competitors can't match. They also have a highly efficient digital and delivery infrastructure, which has been a major growth driver. And as we just saw, their financial metrics, ROI, free cash flow, margins, are best in class. On the weaknesses side, the menu is relatively limited and innovation cycles are slow. They're heavily dependent on a few key ingredients, which exposes them to supply chain and commodity price shocks. And of course, their history of food safety issues is a persistent vulnerability that can erase brand equity overnight. Now for opportunities, there's still a huge runway for domestic expansion, especially in underserved markets. International growth is in the early stages and could be a major long-term driver. They're also investing in automation and technology, like the Hyphen digital make line, which could significantly improve throughput and margins. And they have a new CEO who's focused on operational excellence and getting back to basics. Finally, the threats. The consumer is under pressure, and traffic in the broader restaurant industry is soft. Competition is fierce, with everyone from Qdoba to Moe's to even fast food giants trying to steal share. And then there's the regulatory and litigation risk. We saw a fraud investigation announced just this week. But the biggest threat right now is the food safety issue. If this outbreak escalates or leads to widespread illness, it could trigger another multi-year sales slump like we saw in 2015. Now let's look at the price action. Over the past month, the stock is up over 17%, which is a massive move. But zoom out, and the picture is different. Over the past 6 months, it's down about 1.8%, and over the past year, it's down over 12%. Even over 5 years, it's slightly negative, down about 2%. So the long-term chart is not pretty. The stock has been in a downtrend for over a year, and this recent bounce looks like a dead cat bounce to many technical analysts. The volatility is high, and the beta is below 1, but that doesn't mean it's a safe haven. When you see news-driven swings of 13% in a week, you know you're dealing with a high-risk situation. So what's the stock actually worth? This is where we bring in the MarketSnap valuation model. Given that Chipotle has solid analyst coverage and reliable forward EPS estimates, the model routes to a forward PE approach as the primary engine, with a DCF as the supporting check. The confidence in this setup is high. It's classified as a mature compounder, a business that's past its hyper-growth phase, but still has durable competitive advantages. Here's where the rubber meets the road. The MarketSnap model puts the fair value for Chipotle at around $30 a share. Now, the stock is currently trading in the mid-30s, around 34 to 35 bucks. So according to the model, the stock is slightly above our rough fair value zone. We're talking about a gap of maybe 5 to 10% to the downside. The model assumes a discount rate of 9%, a terminal growth rate of 2.5%, and a terminal PE of 20. It also assumes the share count keeps declining at 2% a year due to buybacks, and it sets free cash flow conversion at 95% of net income to account for rising capex. Now, these assumptions matter a lot. If you dial up the growth rate or lower the discount rate, the fair value could move up to the $40 to $50 range. If you're more conservative, it could drop below 30. The point is, the current price is roughly in line with what a disciplined model says it's worth, which means there's not a huge margin of safety here. If you disagree with our inputs, you can plug in your own growth or discount rate assumptions on our intrinsic value calculator at MarketSnap.com and see how the number shifts. All right, here's my take. I'm going to be honest with you. I'm not a buyer of Chipotle at these levels. The recent earnings beat was encouraging, but it doesn't reset the risk profile. The salmonella outbreak is a serious overhang. The company itself has said its annual guidance doesn't include the financial impact, which tells you they expect it to hurt. And we've seen this movie before. The 2015 E. coli outbreak crushed the stock, and it took years to recover. On top of that, the valuation is not cheap. At over 30 times trailing earnings and roughly 3.5 times sales, the market is still pricing in significant growth. But with comps decelerating, margins under pressure, and now a food safety crisis, that premium looks hard to justify. The CFO selling shares doesn't exactly inspire confidence either. Now, if you're a long-term believer and you think they'll navigate this like they did before, then the stock could be worth somewhere around $40 or $50 in 5 years. But the MarketSnap model suggests that a $10,000 investment today could be worth around $9,400 in 5 years. That's a slight loss. That's not a compelling risk-reward when there are other opportunities out there. So my verdict is to stay on the sidelines for now. Wait and see how the outbreak plays out, monitor the monthly sales trends, and if the stock drops into the high 20s or low 30s, that's where it starts to get interesting. What do you think about CMG? Is this a buying opportunity or a value trap? Leave your take in the comments below. Thanks for watching. If this helped you think through the story, hit like and subscribe for more stock deep dives. See you in the next one.
MarketSnap brings everything long-term investors use daily into one clean, fast platform. Explore stock financials, SWOT analysis, valuation ratios, 5-year analyst estimates, and our intrinsic value calculator, built with real fundamentals, not hype. All in a layout that's simple to read and ridiculously fast to navigate. And when you want to talk investing, join Nexus, our community where investors share valuations, posts, and stock discussions, all connected directly to the data. Use our stock's intrinsic value calculator to run and save real valuations with no spreadsheets. Share your analysis and valuations with others in the Nexus community. Get daily market summaries in video, audio, and article formats. Track the market with our earnings, dividend, and economics calendar. Our homepage gives you a real-time market overview with interactive heat maps, top market movers, and major index performance at a glance. Track daily performances, discover the most active stocks, and analyze performance across different timeframes, from weekly to yearly trends, and see which industries are leading or lagging. It's free to create an account, with optional access to premium forward-looking data. Try it now at MarketSnap.com and invest with clarity, not noise. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and make sure to stick with us for daily updates and deep dive SWOT analyses to keep your investment strategy sharp. Whether you're navigating short-term turbulence or building wealth for the long haul, we've got the insights to help. See you tomorrow.